Welcome to the Deep Dive. We're here to cut through the noise and help you get genuinely well informed. Today, our mission really is to unpack this pretty complex web of global market reactions and economic trends. We're focusing specifically on these escalating trade tensions that seem to be reshaping, well, everything. We've dug deep into a comprehensive market report, looked at key economic indicators, connected the dots, basically trying to give you a clear, concise picture of what's happening. Think of it as, your shortcut to understanding the big economic shifts without getting totally bogged down in the details.
Absolutely. And that big picture, it's just so interconnected these days. What's really crucial now, I think, is understanding how, say, a policy shift in one place, like a tariff threat, can send ripples right across currency markets, affect oil prices, even change growth forecasts thousands of miles away. It's a complex global dance, really. And we'll try to show you the steps.
Okay, let's kick off with the U.S., the economic powerhouse, right? We just got the latest inflation data for June 2025, and there are some intriguing signals in there. The headline CPI, Consumer Price Index, it tracks costs. That rose 2.7% year on year. And core CPI, which strips out volatile stuff like food and energy, that was up 2.9% year on year.
Right. And digging into the report, a pretty significant driver of that increase, it came from imported consumer goods, things we buy all the time, coffee, electronics, furniture. This looks like an early sign, maybe, that those tariff-induced price pressures, they might be starting to filter through to your wallet.
That's a really key point. But interestingly, it wasn't across the board, was it? We actually saw lower prices for vehicles and costs for services, things like airline tickets, hotel rooms. They didn't jump that much, which helped keep the underlying inflation sort of contained, for now anyway. So with those mixed signals on inflation, how did the markets react?
Well, the reaction was pretty clear, actually. We saw Treasury yields, government borrowing costs move higher, and the dollar got stronger. Basically, investors started dialing back their bets on the Federal Reserve cutting interest rates soon. They're thinking maybe the Fed needs to stay tighter for longer if these tariff pressures keep up.
And just to make things more complicated, the political side is buzzing too. President Trump was publicly criticizing Fed Chair Powell again, even suggesting things like cost overruns at the Fed's headquarters could be grounds for firing him. How much does that kind of political noise actually matter in the grand scheme? Is it just chatter, or does it really sway investors?
That's a really important question because, markets generally hate uncertainty. And while maybe one comment doesn't shift the fundamentals, persistent political pressure on an independent central bank like the Fed, that can introduce policy uncertainty. Investors don't like that. It adds a layer of, unpredictable risk. It could lead to more caution, maybe more volatility down the line.
Okay, shifting gears a bit, let's talk tariffs, but in a totally different way.
Yeah.
Not just as negotiation tools, but their impact on U.S. government revenue. It's kind of astonishing.
Yeah.
Get this. In June 2025, customs duties collected surged 301% compared to the year before. 301%. And that actually helped push the federal budget into a surprise surplus for the month.
Yeah, it's a huge number.
To give you a sense of scale, annual tariff revenue is now at USD 113 billion. And projections, they're estimating maybe USD 300 to 350 billion by the end of the year. It's huge.
And this isn't just like a fiscal footnote. It could signal a real strategic pivot. Historically, tariffs are bargaining chips, right? You use them to get concessions. But these numbers, they suggest maybe a shift towards treating tariffs as a structural, ongoing source of cash for the government.
Like a regular tax, almost.
Kind of, yeah. Imagine a world where tariffs are just part of the budget plan, not some temporary weapon. That really changes their role in global trade, doesn't it?
It really does.
Yeah.
So the U.S. seems to be lining into tariffs financially. How are others reacting? Let's look at Europe. They're facing these threats too, but responding differently. The euro, for instance, dropped to a 3-week low pretty much right after Trump mentioned that 30% tariff threat against the EU.
Right. And the European Commission's response is quite telling. They're saying, look, we still want to negotiate a settlement. They prefer de-escalation. But at the same time, they've pushed back the deadline for their own countermeasures into early August. Gives them breathing room for talks, but keeps their options open if things go south. It's a diplomatic tightrope walk.
Definitely. And amidst all this geopolitical back and forth, the oil market has been, choppy, prices bouncing around. Traders are weighing the risk of new U.S. sanctions on Russia against, surprisingly, signs of pretty ample global supply. What drove that initial price spike, and then what cooled things down?
Well, Brent crude, the benchmark, it popped above USD 70 early in the week. That was mostly after Trump announced sending Patriot missiles to Ukraine and made a big statement on Russia. So naturally, speculation flared up about tighter sanctions on Russian oil exports, supply worries, basically.
Right.
But then prices eased off a bit. Markets digested the fact that Trump set this 50-day deadline for Russia to reach a peace deal, or else face these secondary sanctions on oil buyers. So that raised some hope, maybe, that a major supply disruption could be avoided. And crucially, there was also fresh data showing Saudi Arabia pumped way over its OPEC plus quota in June, like 400,000 barrels per day extra. That added a lot of supply to the market, helped keep a lid on prices.
Okay, let's pivot over to Asia now. We're seeing a really diverse range of responses to all these global tensions, starting with China. Their economy actually held up pretty well in Q2. GDP grew 5.2% year on year. That puts them on a decent path to hit their government's 5% target for the whole year.
Yeah, stable is the word. And if you look at their trade numbers, exports were up 5.8% in June. What's interesting there is the boost came from stronger shipments to places like Southeast Asia and the EU. Meanwhile, exports to the U.S. down for the third straight month.
So they're actively shifting trade flows.
Looks like it. Finding other markets while the U.S. route is tricky.
And here's a really fascinating bit from China's trade data, rare earth exports. They surged over 60%. Now, obviously, part of that is easing U.S. tech restrictions, maybe more export licenses from Beijing. But what's the deeper strategy here? Is China flexing its muscle in critical minerals?
Oh, absolutely. I mean, China basically dominates rare earth production. These minerals are vital, right? For smartphones, EVs, defense tech, everything. So a 60% surge, especially now, it feels like a strategic signal. They're reminding the world, maybe, just how critical they are in these high-tech supply chains. It generates revenue, sure, but it's also about leverage.
Makes sense. And looking at China's overall trade balance, despite those exports, imports only rose about 1.1%. Domestic demand seems a bit soft, and that led to their trade surplus ballooning to almost USD 115 billion in June alone.
Yeah, that widening surplus is significant. It shows they're exporting way more than they're importing, often points to an economy still quite reliant on external demand rather than strong domestic consumption. That's a longer-term challenge for them, trying to rebalance.
Okay, moving on. Singapore actually delivered a positive surprise. Q2 GDP expanded a solid 4.3% year on year, better than expected.
Yeah, that was unexpected. The drivers were a rebound in manufacturing, plus this thing called front-loaded exports.
Front-loaded exports, explain that.
It's basically companies rushing to ship goods out before potential U.S. tariffs kicked in, like getting ahead of the changes.
Oh, okay, proactive move.
Exactly. Plus, construction stayed strong, and tourism picked up too, thanks to more international visitors. So a few things clicking for them.
That front-loading idea really shows how businesses are trying to navigate these uncertain times, doesn't it? Playing chess with tariffs. But even with that good number from Singapore, policymakers there are still sounding pretty cautious. They're worried about the global backdrop, especially if trade frictions get worse. So the official growth forecast for 2025 remains cautious, like 0.2%.
Right. They're not getting carried away by one good quarter.
Now Japan. Their data looks more mixed, maybe leaning toward challenging. Exports fell again in June, second month in a row, down 0.5% year on year. And the drops were sharpest to the U.S. and China.
Yeah, and this is really worrying for Japan because they face that specific deadline, August 1st. The U.S. is threatening a 25% blanket tariff on Japanese imports unless a deal is struck.
Yeah.
That puts huge pressure on key sectors, especially automakers, industrial exporters. It could be a major drag on their economy if it happens.
There was one tiny positive sign. Imports actually ticked up slightly, 0.2% after months of shrinking. Maybe a hint of domestic demand stabilizing.
Maybe a tiny hint. But honestly, the outlook for Japan looks pretty tough if these trade talks don't succeed. You've got weak consumer spending at home, plus these big export headwinds. They could really struggle for growth momentum in the second half of the year.
Okay, let's round out Asia with Thailand. There, the big focus for investors recently hasn't been so much macro data, but this delayed appointment of the next central bank governor.
Right, and the market's reading of the situation, especially around the frontrunner, Vitai Ratanakorn, is quite interesting. He's generally seen as likely to favor a more dovish stance, which, for you, means leaning towards lower interest rates or keeping them low to help the economy. Markets think his leadership would also mean more coordination with the government on spending to support the recovery.
So the market sees his potential appointment as a signal for easy money policy.
Basically, yes, accommodative policy. which could help keep shorter-term borrowing costs down. Although, the long delay raises some questions about central bank independence.
And it's important context that Thailand's broader economy is still looking pretty fragile. External pressures, some domestic political noise.
Yeah,
It's not an easy picture.
definitely not.
Okay, let's zoom in now on Malaysia. A more granular look. The local market there started the week pretty cautiously, mainly because of those Trump tariff threats we talked about. The main index, the FBMK LCI, closed lower last Friday, July 18th, down about 0.7% for the week.
Yeah, but here's a little counterintuitive point. While the main index, which is mostly big blue chip companies, was down, the broader market actually did better.
Oh, interesting. So smaller companies held up better.
Seems like it. Suggests maybe some underlying resilience there. Looking at sectors, construction had a great week, up over 3%, best performer.
Okay.
Energy, property, industrial, telcos, utilities, they also gained. But consumer stocks, healthcare, finance, tech, plantations, REITs, transporter, they were all down.
A mixed bag then.
Yeah.
What about foreign investors in Malaysia? What were they doing?
They were net sellers. Pulled out about RM 426 million worth of equities week on week as of Thursday. So international players were definitely cautious.
Okay, let's look at Malaysia's own economic numbers. The Industrial Production Index, IPI, growth really slowed down in May, just 0.3% year on year. That's way down from 2.7% in April, and missed the consensus estimate of 2.1%. What dragged that down so much? What's it telling us?
Well, it was mainly dragged down by bigger drops in mining output, that's a key sector, and crucially, manufacturing growth also slowed, both for exports and for the domestic market. So it signals really that Malaysia's industrial side is finding it tough going right now with global headwinds, a challenge for export competitiveness, maybe diversifying the economy too.
But then, like Singapore, Malaysia had a positive surprise. The Statistics Department put out an early estimate for Q2 GDP growth, 4.5% year on year. That was actually better than the 4.2% people were expecting. What drove that upside surprise?
It seems strong consumer demand was the hero here. It managed to offset the drag from weaker exports. The services sector grew a healthy 5.3%, helped by things like a public sector pay rise, school holidays, seasonal spending. Agriculture was up 2%, led by oil palm. And manufacturing and construction posted gains too. So the domestic consumer provided a really crucial cushion.
Okay, so even with some good news, like that GDP number, what are the main short-term uncertainties still hanging over Malaysia that, you, our listeners, should keep an eye on?
Yeah, there are definitely a few key things. First, that big uncertainty around the U.S. tariff talks. Will they get relief from that 25% tariff by the August 1st deadline? That's huge. Second, potential U.S. restrictions on AI chip exports to Malaysia. That could hit their growing tech sector. Third, we're seeing foreign investors pulling back, and there aren't many strong, positive local catalysts right now. And finally, looking domestically, the rollout of the expanded sales and service tax later this year, plus changes to electricity tariffs, those could potentially squeeze consumer spending and make it harder to predict company earnings.
Got it. And just quickly, the Malaysian government securities market, the MGS market, how did that fare?
It traded a little weaker last week. Market folks still digesting the recent interest rate cut and, of course, that looming U.S. tariff threat. But interestingly, a recent auction for new 30-year MGS bonds drew really healthy demand. The bid-to-cover ratio was 2.00 times, meaning investors wanted twice as much as was available. Shows strong appetite for that long-term government debt.
And the yields themselves.
Benchmark levels didn't move dramatically. The 3-year MGS yield was unchanged at 3.08%. The 7-year edged up just 1 basis point to 3.35%. And the 30-year actually saw its yield dip slightly, down 5 basis points to 3.92%.
Okay, so we've covered a lot of ground there. Navigating this really intricate web of global trade tensions, seeing how they pop up in specific economic data, market reactions from the U.S., Europe, right across Asia, down to the specifics in Malaysia. It's a very dynamic situation.
It really is. And what just jumps out is how interconnected everything is, isn't it? A tariff threat over here ripples through currencies over there, affects oil prices globally, impacts GDP in specific countries. It really highlights the global nature of these economic challenges. Local factors can get swamped by international events so quickly now.
Absolutely. And that leads us perfectly into a final thought for you to mull over. Given this trend, we discussed tariffs potentially becoming less of a temporary bargaining chip and more of a structural source of government revenue for some countries. How might that fundamentally reshape global trade deals, global supply chains? What could it mean for the next generation of businesses operating internationally? And maybe closer to home, what could it mean for your cost of living as a consumer down the road? Something to think about as you go about your day.